Today, we are diving into one of the most powerful, accessible, and beginner-friendly investment tools in the world, ETFs, exchange-traded funds. Whether you're a complete beginner trying to start your investment journey or an experienced investor wanting a deep understanding of how ETFs work under the hood, this is ultimate and complete guide you have been looking for. By the end of this video, you will know what ETFs actually are, how they work, why they've become so popular, how to choose the right ETFs for your goals, 10 mistakes beginners make, and how to build a simple ETF portfolio that can genuinely change your financial future. This is your full ETF Masterclass. So let's get started. Let's begin with number one question. What is an ETF? An ETF, or exchange-traded fund, is a basket of investments you can buy and sell on stock market. Think of it like a shopping cart, filled with lots of different items. Instead of buying one stock, like Apple, Tesla, or Amazon, you can buy one ETF that contains hundreds or even thousands of stocks inside it. Example, buying one share of the S&P 500 ETF, you instantly own a tiny piece of 500 major US companies. Pretty cool, right? How is this different from mutual funds? Both ETFs and the mutual funds give you access to a diversified basket of assets. But ETFs have some key advantages. Traded on stock exchanges like normal stocks, bought and sold instantly throughout the day, lower fees generally, more tax efficient, more accessible for beginners. Mutual funds, on the other hand, can only be bought and sold at the end of the trading day, and they often have higher fees. This is why ETFs have become one of the most popular investment vehicles worldwide. To understand how ETFs operate, we need to look behind the scenes. First, the ETF provider companies like Vanguard, Fidelity, BlackRock, Shares, State Street, SPDR, Invesco. These companies create ETFs. Second, the underlying assets. Each ETF tracks something. For example, stocks, bonds, real estate, commodities, countries, crypto, currency, themes. There are ETFs for almost anything you can imagine. Third, the fund structure. When an ETF is created, the provider buys all the assets inside it, say the 500 companies, and then issue ETF shares. Investors like you and me buy those ETF shares on the stock market. Fourth, creation and redemption mechanism. Simple explanation instead of getting lost in technical jargon. Here is the easiest way to understand it. When demand rises, new ETF shares are created. When demand falls, shares are removed. This keeps the ETF price close to the value of its underlying assets. This unique structure is part of what makes ETFs efficient, liquid, and affordable. There are dozens of ETF types, but let's break them down into the most important categories. Equity ETFs, stocks ETFs. These invest in companies. Examples, S&P 500 ETFs, global stocks ETFs, emerging market ETFs, sector ETFs, technology, energy, healthcare, dividend ETFs. These are the most popular with long-term investors. Second, bond ETFs. Bond ETFs invest in government, corporate, or municipal bonds. Examples, short-term bond ETFs, high-yield treasury ETFs, good for conservative investors, all as a stabilizer in a portfolio. Third, commodity ETFs. These track physical goods, gold, silver, oil, agricultural products. Popular example, gold ETFs. Fourth, thematic ETFs focus on long-term themes like artificial intelligence, clean energy, robotics, space exploration, cybersecurity. These are trend-driven and more volatile. Fifth, real estate ETFs, rate ETFs. ETFs that invest in property and real estate investment trusts. Great for passive income. 6th, currency ETFs. Track exchange rates. Example, US dollar versus Euro ETFs. 7th, crypto ETFs, a newer category, including Bitcoin or Ethereum ETFs. 8th, leveraged and inverse ETFs. These are high-risk, complex products. They attempt to multiply returns 2 times or 3 times. Profit when the market falls. Inverse ETFs. Beginners should avoid this. ETFs aren't just popular. They have completely changed modern investing. Here are the top reasons. First, low cost. ETF fees are tiny. Example, some S&P 500 ETFs charge 0.03% per year, which is almost nothing. Low fees equals more money compounding over time. Second, instant diversification. Instead of owning one stock, you own hundreds in one click. Third, easy to buy. If you can buy a stock, you can buy an ETF. Fourth, liquid and flexible. You can buy and sell anytime during market hours. Fifth, transparent. ETFs holdings are often visible daily. Sixth, beginner friendly. They remove guesswork. You don't need to pick winning stocks. Seventh, tax efficient, especially compared to mutual funds. Index fund versus ETFs. People often confuse these two. Let's clear it up. Index fund tracks an index, but is bought like a mutual fund. ETFs tracks an index, but trades on the stock market. Main difference? ETFs trade intraday. Index fund don't. Fees are often similar, but ETFs always win. How to pick the right ETF. This might be the most important part of the entire guide. Let's walk through a simple ETF checklist. First, what's your goal? Are you investing for retirement, income, growth, short-term safety? Your goal determines the type. Second, what index does the ETF track? This is huge. 2 ETFs may look identical but track different indexes. Examples, FTSE All World, MSCI World, S&P 500, NASDAQ 100. Always check the index. Third, fees, expense ratio. Lower is generally better. Fourth, diversification. How many companies? How many countries? Is it concentrated? Fifth, ETF provider reputation. Stick to known names. Vanguard, Fidelity, iShares, SPDR. ETF size. Assets under management. Bigger ETFs are more stable and liquid. Seventh, liquidity, trading volume. You want high volume for tight bid-ask spreads. Eighth, performance versus index. Does the ETF track the index closely? Look at tracking error. Ninth, dividend policy. Does it distribute dividend to you? Distributing? Reinvest them automatically, accumulating? This matters for tax planning. 10th, currency. Currency exposure can affect returns. For example, US dollar denominated ETFs versus Great Britain pound denominated ETFs. Now that we understand ETFs, let's talk strategy. First, buy and hold. Term investing. The simplest and the most powerful strategy. You buy ETFs that track the global market or a major index and hold them for years or decades. Second, dollar cost averaging. Invest the same amount monthly. This reduces emotional decision making and averages your cost over time. Third, core satellite strategy. Core, broad, stable ETFs. For example, S&P 500 Global Index. Satellites, high-risk thematic ETFs, AI, clean energy, etc. This balances safety and growth. Fourth, income investing. Using dividend ETFs or rate ETFs to build passive income streams. Fifth, all-weather portfolio. Ray Dalio's approach using stocks, bonds, commodities, inflation hedges. ETFs make this easy. 6. Sector rotation. More advanced, move between sectors based on market cycles. 7th, geographical diversification. Mixing US market, Europe, Asia, emerging markets. Let's talk about the mistakes beginners make. Mistake 1, choosing too many ETFs. More ETFs, more overlap. You don't need 20 ETFs. Mistake 2, chasing performance. Just because an ETF did well last year, it doesn't mean it will again. Mistake 3, buying thematic ETFs without understanding them. Themes can be exciting but risky. Mistake 4, ignoring fees. Small fees compound massively over decades. Mistake 5, not knowing the underlying index. Always check the index. Mistake 6, trading too often. Frequent trading destroys long-term gains. Mistake 7, forgetting about taxes. Dividends and current exposure matter. Mistake 8, using leverage without understanding the risks. Leverage ETFs can lose money quickly. Mistake 9, not having a plan. Investing without clear strategy leads to emotional decisions. Mistake 10, forgetting that ETFs still carry risks. They are diversified but not risk-free. Let's put everything together into a simple portfolio example. Option 1, Ultra Simple Portfolio, 100% global stock ETF. Covers thousands of companies worldwide. Great for long-term beginners. Option 2, Balanced Portfolio, 70% global equity ETF, 30% bond ETF, lower risk, smooth growth. Option 3, Growth Portfolio, 60% S&P 500 ETF, 20% global ETF, 20% emerging markets. Focus on long-term growth. Option 4, Income Portfolio, 50% dividend ETF, 30% bond ETF, 20% rate ETF, good for passive income. Option 5, Core Satellite Portfolio, core 70%, global ETF and S&P 500 ETF, satellites 30%, AI ETF, clean energy ETF, robotics ETF. The ETF industry is exploding. Trends going forward: more crypto ETFs, more AI-driven ETFs, actively managed ETFs, ultra-low-fee ETFs, customizable portfolios through fractional shares. ETFs will likely dominate the next decades of investing. ETFs are one of the most powerful tools, affordable, diverse, flexible, beginner-friendly, long-term wealth builders. Whether you're investing for retirement, income, financial freedom, or simply to grow your wealth safely, ETFs can be the backbone of your strategy. If you enjoyed this full deep dive guide and want more tutorials on individual ETFs, portfolio building, or investing psychology, hit the like button, subscribe, and tell me which topic you want next. Also, please watch our next video here. Thanks for watching, and I will see you in the next video.